There's a clause buried in your bank account agreement that gives your bank the legal right to delay your withdrawal for 7 days. No reason needed, no public announcement, no emergency declaration required. Most people have never read it. Most bank employees won't tell you about it, and the financial media won't explain it. But it's there, right now, in your savings account. And with $500 billion in unrealized losses sitting on U.S. bank balance sheets, that clause might actually get used. Stay with me because what I'm about to show you could save your wealth. What's up, everyone? This is Con Invests. If you're new here, this channel is all about protecting your wealth, understanding precious metals, and navigating the financial system with real information. If you find this valuable, hit that subscribe button and drop a comment below. Your engagement helps this reach more people who need to hear this. All right, let's dive in. Let me start with the foundation because you can't understand where we are without knowing how we got here. The clause I mentioned, the 7-day withdrawal delay, is codified in the Code of Federal Regulations under Title 12, Part 204, Regulation D. It states that a bank reserves the right at any time to require 7 days advance written notice of an intended withdrawal from a savings deposit. Those are the actual words. This isn't a conspiracy theory, it's federal law, and it's been there since the 1930s. Why? Because after the Great Depression, when 9,000 banks failed between 1930 and 1933, regulators redesigned the entire banking system. They created the FDIC, they introduced deposit insurance, and they embedded a pressure valve into the system, a tool that could slow withdrawals without triggering a public panic. That valve is the 7-day notice clause. For 90 years, it wasn't needed, but it was always there, waiting. Here's where things get critical for your money today. After the 2008 financial crisis, global regulators created a new framework for handling bank failures. It's called the bail-in framework. The core principle is this: when a bank fails, the cost should be borne by the bank's stakeholders, not taxpayers. This framework is law in the United States under the Dodd-Frank Act. It's law in the European Union, the UK, Canada, Australia, and across all G20 nations. Here's how it works. When a systemically important bank enters resolution, the FDIC takes control. Shareholders are wiped out first. Then bondholders take losses. And then, if more capital is needed, uninsured deposits above $250,000 can be converted into equity. Not withdrawn, not returned, converted. You become a shareholder in a restructured bank that may take years to resolve and may return cents on the dollar. This isn't theoretical. It was tested in Cyprus in March 2013. Depositors with balances above 100,000 euros lost up to 47.5% of their savings. Those funds were converted into bank equity overnight. The Financial Stability Board called it a successful proof of concept. The template was codified, the framework was expanded, and it now governs every major Western economy. So what does this have to do with your bank account today? Let me show you the data. As of the end of 2024, U.S. banks held $481 billion in unrealized securities losses. That's nearly 20% of the entire capital cushion of the banking system. By spring 2025, that number approached $500 billion as interest rates rose again. These are paper losses on bonds and securities that banks bought during the zero-rate era. When rates went up, the value of those bonds went down. The losses are unrealized. They don't show up on income statements unless the bank is forced to sell. A Stanford finance professor who studies systemic banking risk told Fortune directly, "At a 10-year Treasury yield above 4.5%, the banking system starts seeing serious problems. At 5%, it becomes quite bad." As of this recording, the 10-year yield is in exactly that zone. Remember Silicon Valley Bank in March 2023? SVB wasn't a rogue institution. It was doing what hundreds of regional banks were doing, buying long-duration Treasury securities to earn yield. When rates rose, the market value of those securities fell. The losses were disclosed in footnotes that nobody read. But when depositors started moving funds, SVB was forced to sell. The moment it sold, paper losses became real losses. The capital cushion evaporated. Regulators arrived on a Friday. By Monday, the bank was gone. And here's the critical point. SVB revealed a structural vulnerability that exists across hundreds of regional banks today. Now let's talk about what's building right now in commercial real estate. Commercial real estate office loan delinquencies hit 10.4% in the second half of 2025, approaching 2008 peak levels at the fastest rate of increase on record. Regional banks hold approximately 44% of their total loan books in commercial real estate, compared to just 13% at the largest banks. Over $1 trillion in commercial real estate loans matured by the end of 2025. More are maturing through 2026 and 2027. When these loans mature, the borrower either pays off the balance, refinances at current rates, or defaults. There's no fourth option. Refinancing at 6 to 8% on a property that's declined 30 to 40% in value isn't economically viable. Banks have been using extend and pretend, modifying loan terms to avoid recognizing defaults. But that window is closing. New research published in late 2025 found that latent distress in commercial real estate, loans that would be underwater at today's values, even if not yet delinquent, is approximately 4 times larger than current delinquency statistics show. The banks aren't recognizing these losses yet, but they will have to. Let me walk you through exactly how this plays out from a depositor's perspective. Step 1. A regional bank with concentrated commercial real estate exposure reports elevated loan loss provisions in quarterly earnings. Step 2. Analysts flag it. A journalist picks up the story. Step 3. Within 24 to 48 hours, depositors with uninsured balances above $250,000 start calling the bank. Some start moving funds. Step 4. The bank's overnight funding position deteriorates. Step 5. The bank activates its liquidity contingency plan. One of the tools in that plan is the 7-day notice clause. The bank doesn't need regulatory approval, it doesn't need to declare an emergency. It just activates a right that's existed in deposit agreements since the accounts were opened. Customers receive written notice, withdrawals are delayed for 7 days. From the depositor side, the notice is the first visible signal something is wrong. But the balance sheet stress didn't start that day. It started months or years earlier. The notice isn't the beginning of the problem, it's the moment the problem becomes impossible to manage in private. Now let's talk about what the FDIC can actually do. The Deposit Insurance Fund held $150 billion as of Q3 2025, with a reserve ratio of 1.40%. That means the fund covers $1.40 for every $100 of insured deposits. Total insured deposits in the U.S. are measured in the low tens of trillions. The fund is sized to handle individual bank failures. It's not sized for a simultaneous stress event across multiple institutions. That's why the bail-in framework exists. In a systemic scenario, the FDIC uses the orderly liquidation authority to recapitalize failing institutions using the bank's own liability structure, including uninsured deposits. Here's what most people don't understand. When you deposit money at a bank, you're not placing it in a vault. You're making an unsecured loan to the bank. The bank records your deposit as a liability, then deploys those funds into loans and securities. You become an unsecured creditor of the institution. For balances above $250,000 per depositor per institution, there's no insurance backstop. In an orderly liquidation, your claim ranks below the bank's derivative obligations, below secured debt, and alongside other uninsured depositors. The timeline and outcome are determined by the FDIC as receiver, not by you. Every previous banking crisis had a backstop of last resort. In 1933, it was the creation of the FDIC. In the 1980s S&L crisis, it was the Resolution Trust Corporation. In 2008, it was TARP and the Fed expanding its balance sheet from $1 trillion to $3 trillion. In 2020, it was zero rates, $4 trillion in Fed asset purchases, and direct fiscal transfers. But the starting point today is fundamentally different. U.S. federal debt stands above $36 trillion. Interest payments exceed the entire defense budget. The Federal Reserve's balance sheet is over $7 trillion. The Fed funds rate is 3.5 to 3.75%, with inflation still elevated. This means the tools used in 2008 and 2020 have limited room to operate. Cutting rates to zero would fuel inflation. Expanding the Fed's balance sheet further would be historically unprecedented. Congressional authorization for another bailout would require political consensus that doesn't exist. The bail-in framework is the lowest cost option from the government's perspective. It's resolution without new taxpayer money. It doesn't require congressional authorization, it just requires the FDIC to invoke existing legal authority. Let me be clear about the practical implications. First, understand your actual coverage. If you hold more than $250,000 at a single institution, the excess is uninsured. Spreading deposits across multiple FDIC-insured institutions to stay within the insurance limit is straightforward. The FDIC's lookup tools are public and free. Second, understand what sits outside the banking system. Physical gold and silver held in your possession or in allocated, segregated private storage sit entirely outside the banking system. They're not subject to the 7-day clause, not subject to orderly liquidation authority, not part of any institution's liability structure. Central banks globally purchased record quantities of gold in 2024 and continued through 2025. China, Russia, India, and Middle Eastern sovereign wealth funds have been systematically building gold reserves. These are institutions with the analytical resources to understand exactly what's on Western bank balance sheets. They're not buying gold because they expect a collapse next week. They're buying because they're managing tail risk in a system under structural stress. Silver is trading at a significant discount to gold historically, while facing supply constraints from industrial demand in solar, EVs, and defense. Physical silver demand has been exceeding mine supply, and above-ground inventories are at multi-decade lows. Third, timing matters. The decisions above, reviewing deposit coverage, understanding account structure, establishing positions outside the system, don't require an active crisis to justify. They become materially harder to execute once a confidence event is underway, because by then the sequence is in motion and the 7-day clock may already be running. Here's the current state with precision. U.S. banks carry close to $500 billion in unrealized securities losses, roughly 20% of aggregate banking system equity. Commercial real estate office delinquencies are approaching 2008 peaks at the fastest rate ever recorded. Regional banks hold nearly half their loan books in commercial real estate. Latent distress is estimated at 4 times current delinquency statistics. The FDIC fund has a 1.40% reserve ratio, above the minimum but not sized for systemic stress. The bail-in framework is legally active across all major Western economies. The 7-day notice clause is in your account agreement right now. What's not determined is the specific trigger. We don't know which institution, which earnings report, which commercial real estate default, or which external shock will convert latent stress into a visible sequence. But a Stanford finance professor studying bank fragility stated it directly in May 2025. The ingredients for stress are still present, especially if macroeconomic conditions deteriorate. He's describing a system that's loaded, not discharged. Your savings account is not a vault. Your deposit is a liability on a balance sheet. The insurance protecting it has a cap and a fund with quantifiable limits. The legal framework governing what happens if your bank encounters stress was redesigned after 2008 to protect the system first and the depositor second. by explicit statutory design. This isn't the end of the sequence. The next data points will arrive in the coming weeks and months. I'll be tracking FDIC reports, commercial real estate maturity data, regional bank earnings, and regulatory filings that indicate institutions are approaching stress thresholds. The sequence doesn't resolve in a single news cycle. It develops over months. Each stage will be visible if you know what you're looking at. Stay with this channel because the next development isn't a prediction. It's a disclosure that's already been made somewhere in a regulatory filing that hasn't become a headline yet. The only question is, are you watching this unfold from inside the system without understanding the rules, or from a position you chose deliberately because you read the fine print? This is Con Invests. If you found this valuable, subscribe, hit that like button, and share this with someone who needs to hear it. Stay smart, stay safe, and keep your wealth protected.